Buffett buys Google. In actual fact, it's not really Warren Buffett make the decision. It's by the investment manager, which is maybe GWL or even 𝐻𝐻. So you ask why now? In actual fact, they kind of show some interest before COVID, if I'm not wrong, 2017 or 2019 in their AGM. So one of the things that they shared, how Buffett found out about Google or how being interested in investing in Google is when one of the companies, which is 𝐾𝐨𝐽, have to pay a lot of advertisements money to Google. They might have interest in them, but back then they didn't any investment money. Other than that, Buffett have been like always saying this thing. Tech is not the things that he understands. So that's why he never invested in Microsoft, although Bill Gates is one of his friends. So if you look at Google, then you have to ask, how much they have invested, and then shall we follow? Or if I've invested, it's great news, but if I have not, should I buy right now? So there's a lot of these questions come up, especially if you are new in investing. Just what have been shared in the public is they have invested 4.3 billion into Google, and right now it's the 10th largest stake in their portfolio. Actually, what they have really shared is not just about the number of money, it's the total numbers of shares. But the problem is when they disclose this number of shares, they didn't quite disclose the price that they have invested. We can only know that it's between the last quarter period that they invested in this, and this price range is from 175 to 255. So roughly around $200 average price. And right now is sitting at close to 200, like 50 or 260, right? Actually, they have made some gain if you take the average price off. So with that return, that's 30 to 40% that they've already gained. So for us as an investor, what does it mean? Can I take the investment as well? And if I invest, am I buying too high? Or does it mean that I follow together with Warren Buffett, then I can gain together with Berkshire Hathaway? So let us go back to the investment itself. So if you have not followed us previously, we talked about Google, their latest quarterly earnings, and then specifically to the Cloud Trio sessions that I ran 2 weeks ago. Go to our YouTube channel and then click on live and then click on the Cloud Trio. That's where we share about Amazon, Google, and Microsoft. And then we shared a bit deeply on Google at the session itself as well. So Google have been like in Berkshire Hathaway portfolio at the 10th position, sitting at around $4 billion. Actually, $4 billion is just 1.62% of their portfolio. So even if Google were to double and then the size to around like 2-3%, it just moved like a few percentage points for Berkshire Hathaway. So even if they lost everything, lost the 4 billion, it's just 1.62% of their portfolio. This doesn't mean good or bad news for investor, but this is a situation where Berkshire Hathaway is facing. Let's say I have 100,000 and I invested 20,000 into Google. It might be 20% of my portfolio. The percentage up and down for Google would differ 20 times difference in the percentage compared to Berkshire Hathaway. Whether or not you invest is pretty much depends on your strategy, your portfolio, and the quantum that you're investing into. And also, when you invest, what is the horizon? Let's say if you are interested in following all this stock movement, you can always go to 𝐾𝐨𝐽.io. So you go to 𝐾𝐨, you click on top investor, click on Warren Buffett. This is where you can land on. The questions come to this. People like Warren Buffett or big time investor like Monish Prabhai, like 56% 3-year return, Howard Marks 30%, like Ray Dalio 60%, Li Lu, so-called China Warren Buffett, also gained like 113% for the 3 years return. Charlie Munger 88, Katie Woods 100 over, Bill Gates 69%. So all of these big time investors have made quite a handsome profit, 60 to 100% for the past 3 years. So the question is, with AI, should I just follow their portfolio? Can I set up an AI investing strategy or copy trade or whatever that you name it and just follow their investment or follow what they invest? So first thing that I said just now, size does matter because Warren Buffett or Berkshire Hathaway invest just 1% of their portfolio in Google. All right, so let's say if you are investing, how much are we investing in? Come to our cash in hand, and in order to grow our portfolio, what is the quantum that we have to grow? For example, let's say you start with 1 million, and in order to grow 10x to 10 million, we just need to grow 9 million per year. And compared to another fund or the company, which is another person that's 10 million, go to 100 million, same 10 times return, but he need to grow 90 million. So imagine the size of Berkshire Hathaway. Right now, they are sitting at 300 billion cash. In order to 10x from 300 billion to 3 trillion, they need to gain how much? 2.7 trillion. So the size does really matter, and the amount to invest does really matter. A lot of these investors, when they invest, doesn't mean that they are like Midas. They have this like golden finger. Whatever they touch turns gold, all right? As experienced or as good as investor like Warren Buffett, he has his fair share of mistakes and he openly admit all those mistakes. For example, he invested in Tesco and then he got sold at a loss. He invested in IBM at a loss. And even the company itself, Berkshire Hathaway, is a textile company. He also purposely keep the name itself, Berkshire Hathaway, which is the textile company that he invested, to remind himself he would make mistakes. They aren't always right. And even people like Katie Wood, which is like the persons that investing into a lot of multi-compounder kind of companies. Look at this chart itself, right? So here, she has invested in the earliest day, average price at $9 plus, all right? And then the fund itself sell along the way. They sell along the way. And then interestingly, they buy back at 2025. So they sold, and suddenly buy back, and then buy back much more. They might as well don't sell it and then continue just hold. So coming to this, sometimes they aren't always right in terms of their decision making. And of course, different investor, different fund manager, they have different strategy. And then the strategy will derive at different result. We put aside what is the result, we just focus on the strategy that they took. How are they invested in certain companies? So this is the companies that previously is a crypto exchange. This crypto exchange, like any other stock exchange, how they make money? They make by charging a commission rate or so-called fees. So when the market invested in them, they invest directly into the company, and what they want in the end of the day is to grow with the company. They can make fees, and then when they make fees, they grow. So-called domestic stake in this company will grow as well. So this is a direct investment into the company. So a lot of other investment out there, like retail or even for investors that they don't have direct access to them, they can take another way, which is invested in the coin or token that FTX issued. So for example, FTT. So FTT is not a direct ownership. But back then, he said, "Oh, I want to take part in this growth of this FTX." All right. So buying a token doesn't mean that you directly own the company. But with these two different strategy, right, it might yield different result. But in this particular case, is because it's a fraud. That's why it got bust. But if there's no fraud, right, these two different vehicle or strategy would yield different result. So different investors use different strategies to invest in the company. Different investor, especially the bigger one, they have different negotiating power. And with negotiating power, they can maybe have a preferential rate, or even they might invest because they have some strategic stake or with some strategic deal happening behind. That's why they have different negotiating power. Just like NVIDIA, when they invest in some of the companies that you see here, like for example, CoreWeave, Holding, the Bias Group. So these are companies whereby you know that they have actual business relationship, not just as an investing relationship. And you know that actually there's some business relationship. So when they invest, they might invest not just because they want to have a stake in it, but also they like to have some business relationship that might favors them. They have different negotiating power when they are big. Next, timing and time horizon. So for example, if you look at VCs, like some of the venture capitals, where they manage their funds, right, they have like timing of like maybe 7 to 10 years. So they need to perform within 7 to 10 years. And for some of the portfolio managers, so their results are being reviewed every single year. So for them, the timing and time horizon is very crucial, all right, because they need to perform. And of course, your portfolio concentration. Google is just 1% of Berkshire Hathaway investment. And if you're invested in the company, how much concentrations this investment take? So for example, if you invest in Google and then you invest like 20%, every 1% move is definitely more than how it moved Berkshire Hathaway. All right. If it move up 1% in so-called in Berkshire portfolio, it will move up 20 times in your portfolio because you have 20 times kind of like size. All right. So in other words, portfolio concentration differs and your portfolio would differ. And back to your key idea is, what is your strategy in terms of your portfolio? And lastly, portfolio manager, fund manager need to address to the market, and address to the investor, like Warren Buffett every year, AGM people are like doing with loads of questions. So they need to answer, but they choose to answer shareholder what they do. So some of the fund manager right here, likewise, they need to answer to their shareholder. So that's why they need to take responsibility in terms of like the result But of course, for us, we need to take responsibility of result. Just that we need to be pressure to perform. So if we perform like the market, which is good, at least you perform on the market. And if you perform better than the market, you can celebrate. But if you perform like slightly worse than the market, we are still not pressured because we can sit on the long run. And then we don't need to be pressured by, oh, this year I didn't perform better than market, unlike all the investor listed right here. So in the end of the day, all these investors, when they make all this investment, are being affected by size because they need to be strategic in terms of their size. When they invest, they might not be right all the time. And even if they are right, they might be because their strategies are different from ours. That's why the action is right to their strategy. And when they have the strategy, they might have a different negotiating power because they have larger fund size, or even they have direct business relationship. And timing and horizon is different. Portfolio considerations, for us might be higher. And in the end of the day, they have the answers to your shareholder. So with all this, right, if you are looking at your investment and compare to your so-called portfolio, right, actually for these two portfolio is definitely have different strategy, different time frame. So you ask yourself, when I look at all this portfolio, why should I follow? Yeah. What is the reason that I'm following the investment? If I just copy trade, then the copying, is it true to what their action is? Because all this news is after they have made investment. So for example, Warren Buffett invested, it might be out like 2 to 3 months later. So the point they invest, right, might be differ. And then when they sell, right, you also only know 2 to 3 months later. The worst thing is you will not know the real reason why they buy. You also would not know the real reason when they sell. So you have to ask yourself, when you copy, why do you copy? Is it just because like they are a good fund manager, or because they have good result, then you copy? So my humble opinion is, don't need to follow what exactly they invest. We just take reference on the investment that they pick and then assess it according to our strategy, assessing according to our portfolio, and then see whether it makes sense to add into our portfolio if it's a new investment. If you made it this far, thanks for sticking around. Hit like, check out some of our other videos, and subscribe to stay updated. Until next time.